Hello, everybody. Good morning, good afternoon, and good evening. I wish you a very warm welcome here to Full Trade Weekly webinar. As you can notice, today we are going to discuss the topic related to crude oil inventories and how crude oil inventories could impact crude oil prices. Before I get to the main presentation, I need to go over the risk warning and disclaimer about contracts for difference. Trading CFDs and other leveraged products carries a high level of risk to your capital as prices may move rapidly against you. Second of all, be aware you can lose all, but not more than the balance of your trading account. Third, CFDs may not be suitable for all clients. Therefore, ensure you understand the risks and seek independent advice. You can find the full risk exposure statements at Full Trade websites. Now we can move on. So in this webinar, we are going to consider the most important factors that influence crude oil prices. Biggest crude oil importers, producers and exporters, key bearish and bullish factors for crude oil in 2017, and the most important weekly crude oil reports. So supply and demand relationship along with the market sentiments are one crucial factors that influence the crude oil prices. Also, we have here the amount of production, political unrests, weather, restrictive legislation, so on and so forth. The concept of supply and demand is fairly straightforward. As demand increases or supply decreases, the price should go up. As demand decreases or supply increases, the price should go down. But not quite. The price of oil, as we know, it is actually set in the oil futures markets. An oil futures contract is a binding agreement that gives one the right to purchase oil by the barrel at a predefined price on a predefined date in the future. Under a futures contract, both the buyer and the seller are obliged to fulfill their side of the transaction on the specified date. Unlike most products, oil prices are not quite determined entirely by supply, demand, and market sentiment toward the physical product. Rather, supply, demand, and sentiment toward oil futures contracts, which are traded heavily by speculators, play a dominant role in price determination. Cyclical trends in commodity markets, they also play a role. Now, let's move back to supply and demand relationship. From the side of supply, this graph gives us the world's top oil producers in 2016. We can notice that Russia is the leading producer, used to be the leading producer in 2016, followed by Saudi Arabia, United States of America, and so on and so forth. The next graph is giving us the biggest crude oil exporters in 2016. Here we can note this big gap between the first one and the second one. Saudi Arabia, 20% is far ahead of Russia. Then we have Iraq, Canada, and so on and so forth. So that's on the side of supply. On the side of demand, we have the largest oil importers in 2016. We have here China, United States of America. China, the second largest economy in the world. It's not a surprise to see it leading this list. This is actually, in a way, to give us an answer to the question why it all talks between OPEC and non-OPEC producers about production cuts. The United States of America and China are always excluded, although they're among biggest producers of crude oil. Despite their being among biggest producers in the world, yet they are not among the group of significant exporters. Since 2008, US crude oil production has nearly doubled to 9.35 million barrels per day, helped by the rise in prices starting at the end of November. Yet, the shale oil that has been the basis of the revolution is a lighter, less viscous oil, and US huge 18.6 million barrels per day of refining system is generally configured to process heavier crudes from the likes of Canada, Mexico, or Venezuela. This is basically why US imports still remain high, with crude intake reaching 8.6 million barrels per day in May 2017. The next graph, actually this graph, is giving us crude oil price movements over the past year. So we see in 2016, the lowest point was $26 per barrel. That was kind of bottom point when markets got so much disappointed that amid global oil oversupply, no big oil producers were ready to step in and to limit their daily production. So that was the bottom. But then soon after that, they realized that this big concern could really have heavier impact on crude oil prices. Rumors started to go out regarding the fact that they may have started to big oil producers may have started to maybe find a common ground and to come up with an agreement whereby daily oil production will be cut. So based on these rumors, crude oil prices really found found very strong support in these rumors. But the final agreement was made in late November 2016, when OPEC organization decided to agree to cut daily production by 1.2 million barrels. And soon after that, a couple of days later, Russia and other non-OPEC producers decided to join the agreement by cutting their production by 0.6 million barrels per day starting January 2017. And that caused crude oil prices for a moment to trade above $55 a barrel. Now let us consider key bearish drivers for crude oil in 2017. Here we have a couple of them numbered. The first in a line, U.S. production. The U.S. Energy Information Administration reported that U.S. production last week slipped a bit, but this was the first decline 30 weeks. The agency still expects U.S. production to advance on average in 2017. U.S. crude oil production peaked at 9.6 million barrels per day in June 2015. In contrast, it hit a low of 8.43 million barrels per day for the week ending July 1st, 2016. Since then, yet U.S. crude oil production in the United States of America was only going up. Next in line is U.S. crude oil inventories, which at the moment are near 30-year seasonal record high. The U.S. Energy Information Administration said on Wednesday that crude inventories fell by 4.43 million barrels for the week to May 19, compared with expectations for a decrease of 2.4 million barrels. On the other hand, the American Petroleum Institute late Tuesday reported a decrease of 1.5 million barrels. Crude oil inventories remain near the highest seasonal record in the last 30 years. U.S. crude oil inventories hit an all-time high of 543 million barrels in the week ending April 29th, 2016. Since then, they have fallen, but kept moving near these record highs. Third, bearish driver, Donald Trump's energy policy. To this end, let's skip to this, move to this slide. It tells us more about Trump's energy policy. First of all, Donald Trump supports increasing the production of fossil fuels like coal, crude oil, and natural gas. It could support, according to him and his administration, that could support employment and benefit the economy. Second, he proposes to lift regulatory restrictions on crude oil and natural gas exploration and production. He also plans to bring more federal lands under crude oil and natural gas drilling. He also supports the Keystone Pipeline project that may increase the crude oil supplies to the United States of America from Canada. Donald Trump also supports the coal industry, one of the key sectors to blame for environmental pollution. By the way, falling coal prices saw a wave of bankruptcies and job losses in the sector over the last few years. Let's get back to the main slide. Next one is rising. Investors also, they fear rising Libyan crude oil production that may have serious impact on crude oil prices in 2017. Fighting in early March in Libya led to the closing of two of Libya's main oil terminals, forcing a number of fields to stop pumping. The ports have since reopened. Libya, this graph can tell us more about Libya's production over the past decades. As a matter of fact, Libya pumped as much as 1.6 million barrels a day before an uprising in 2018, which led to a fall in output, and is currently one of the smallest producers of the Organization of Petroleum Exporting Countries, or OPEC. Libya's crude production rebounded to more than 700,000 barrels a day as the OPEC members' biggest oil field and another deposit in its western region resumed pumping after a halt. So this chart can tell us more precisely. So we're around here 700, let's say, and if Libya's crude oil production manages to come back to pre-war levels, that would have serious impacts on crude oil inventories and crude oil and consequently crude oil prices. Fifth in line is OECD countries' crude oil inventories. The U.S. Energy Information Administration estimates that OECD's crude oil inventories, so OECD stands for Organization for Economic Cooperation and Development, fell in last month 0.2% month over month, but rose 0.6% year over year. This also could have negative impact if the same pace continues on. Sixth in line, Iran's crude oil production. The American Energy Information Administration estimates that Iran's crude oil production was flat at 3.81 million barrels per day in April 2017 compared to March 2017. That production rose by 8.8% on a yearly basis. Iran's crude oil production is at the highest level in 7 years. Iran was able to increase its production after the US lifted sanctions on the country in January 2016. A rise in production from Iran pressured oil prices in 2016 and early 2017. On May 15th, 2017, Saudi Arabia and Russia's energy minister said that Iran would extend the production cut deal for 9 more months. Some analysts think that Iran could favor the production cut deal after it hits the target of 4 million barrels per day of crude oil production in 2017. Any capping of production from Iran could support the oil market, and that could have positive impact on crude oil prices. Last on the list is the strong US dollar. The dollar hit a high of one US dollar index actually hit a high of 103.8 on January the 3rd, 2017, which was the highest level in 14 years. It is now down more than 4.5%, but still it is pretty much high. And the US dollar and crude oil prices, they move inversely. So a fall in the US dollar makes crude oil more economical for oil importers. When the dollar falls, that means that crude oil prices should rise. Several factors to blame why the US dollar has been appreciating. The first one is a better than expected rise in US manufacturing activity in December 2016, strong US economic growth outlook, improving labor market expectations of rising US inflation, expectation of fiscal stimulus from Trump's administration too. So this is to conclude the list of bearish drivers for crude oil in 2017. Next one is to consider, next slide is to consider bullish drivers for crude oil 2017. First one appears to be in the shape of successful implementation of major oil producers production cut deal. On May 15, 2017, Saudi Arabia and Russia's energy ministers said that the countries would extend the major producers production cut deal for 9 more months. The extension would start from July 2017 and would end in March 2018. The deal cut production by 1.2 million barrels per day from OPEC and 0.6 million barrels per day from non-OPEC producers. As a result, crude oil prices jump during electronic trade when this news was announced. The official OPEC meeting was scheduled to take place today, May 25th, 2017, and that information was just officialized that OPEC and non-OPEC producers will extend oil production cuts a deal until until March 2018. Next bullish driver, India and China's crude oil demands. Government data actually recently showed India's oil imports in April rose about 0.9% from a year ago to 18.1 million tons, while export of oil products increased by about 6%. The data for imports and exports is preliminary because private refiners share numbers at their discretion. A rise in domestic demand led to the rise in refinery demand. It led to the rise in crude oil imports too. India is the second largest crude oil consumer after China in Asia. The National Energy Agency projects that India's crude oil demand growth rate will be the highest by 2040. The very same agency actually estimates that India is the 4th largest country in terms of global refining capacity. So we can realize that India is quite big, could be a quite big driver for crude oil prices in 2017. Bloomberg estimates that China's crude oil imports fell by 810,000 billion barrels per day to 8.4 million barrels per day in April 2017 compared to the previous month. China's crude oil imports fell 8.8% month over month, but rose 5.5% on a yearly basis. Imports fell due to the fall in demand from its teapot refineries. China's crude oil imports averaged 7.6 million barrels per day in 2016, 13.2% higher than 2015. China's crude oil imports rose to 9.21 million barrels per day in March 2017. Imports were at the highest level ever. So we see India and China, their demands for crude oil could lift or could give boost to crude oil prices over the period that follows. Third in line, US gasoline demands. The US Energy Information Administration estimated that the 4-week average US gasoline demand rose by 33,000 barrels per day to 9.25 million barrels per day between April and May 2017. US gasoline demand rose 0.4% week over week, but fell 2.4% year over year. The very same agency estimates that US gasoline consumption will average 9.3 million barrels per day in 2017. US gasoline consumption averaged 9.3 million barrels per day and 9.2 million barrels per day in 2016 and 2015, respectively. US gasoline consumption hit a record high in 2016 too. High gasoline consumption in 2017 could only give support to gasoline and crude oil prices in general. So we've just numbered the key bullish and the key bearish drivers for crude oil in 2017, which are worth to follow and could be really useful in your trading strategy when it comes to trading crude oil. Crude oil prices crude oil price is in recent years predominantly influenced by fundamentals, while producers try to regain previous control over its price, which was in a way lost during the battle for the market share. For that reason, it is very important to closely follow all news, exceptionally those relating to OPEC and non-OPEC agreements about the production cuts. On a weekly basis, we have, you can see here on the slide, we have 4 reports published in the United States of America, which have a strong influence on the price as they are closely showing supply, production in the United States of America. So the first one is the American Petroleum Institute Crude Oil Inventory Report. The second one, the report which is published by the Energy Information Administration in the United States of America. Again, US Cushing crude oil inventories and Baker Hughes oil rig count. Reports about Russia and OPEC production cannot be found in the economic calendar. They are monthly reports published by the government bodies, and they can be found in reliable sources and are usually followed by the media, which are specialized for this kind of topics. While the Energy Information Administration oil inventories and Baker Hughes oil rig count report you can find on our calendar. And American Petroleum Institute reports can be followed just on their official websites, but sometimes happens to be also published on our calendar on our website. So as we mentioned, we just mentioned the most important economic reports. Now we can move to the first one to consider more in detail. The first one, American Petroleum Institute crude oil inventory, which is released each Tuesday at 9:30 GMT plus 1. The American Petroleum Institute is the largest U.S. trade association for the oil and natural gas industry. It claims to represent about 650 corporations involved in production, refinement, distribution, and many other aspects of the petroleum industry. The figure shows how much oil and product is available in storage. The indicator gives an overview of U.S. petroleum demand. So, if the increase in crude inventory is more than expected, it implies weaker demand and is bearish for crude prices. That's the logic. The same can be said if a decline in inventory is less than expected. If the increase in crude is less than expected, it implies greater demand and is bullish for crude prices. The same can be said if a decline in inventory is more than expected. So that kind of detailed report about American Petroleum Institute crude oil inventory report. Now we can move on to the second one that is released by the U.S. government or the Energy Information Administration in the United States of America, that comes out each Wednesday at 3:30 p.m. GMT plus 1. This report actually measures the weekly change in the number of barrels of commercial crude oil held by U.S. firms. The level of inventories influences the price of petroleum products, which can have an impact on inflation. If the increase in crude oil inventories is more than expected, it implies weaker demand and is bearish for crude prices. The same can be said if a decline in inventories is less than expected. If the increase in crude is less than expected, it implies greater demand and is bullish for crude prices. The same can be said if a decline in inventory is more than expected. We've just gone through American Petroleum Institute's reports, U.S. government's reports. The third one appears to be in the name of U.S. Cushing crude oil inventory, which comes out each Wednesday at 3:30 p.m. GMT plus 1. Cushing is a major trading hub for crude oil and a famous price settlement point for West Texas Intermediate on the New York Mercantile Exchange, vital transshipment point with many intersecting pipelines, storage facilities, and easy access to refiners and suppliers. There is approximately 85 million barrels of crude oil storage tanks around Cushing, the most significant trading hub for crude oil in North America that connects Gulf Coast suppliers with northern consumers. Cushing is a delivery point for West Texas Intermediate, a blend of U.S. light sweet crude oil streams traded on the New York Mercantile Exchange. Cushing's strategic position as a major hub in oil supply led to the development of West Texas Intermediate type of oil as a significant physical market price reference or benchmark for over 3 decades. Change in the number of barrels of crude oil held in storage at the Cushing, Oklahoma during the past week. So that's actually what the report is measuring. So the change in the number of barrels of crude oil held in storage. Storage levels at the Cushing are important because it serves as the delivery points for the U.S. crude oil benchmark, so-called West Texas Intermediate. Fourth one, Baker Hughes oil rig counts, which comes out each Friday at 6 p.m. GMT plus 1. Baker Hughes is an American industrial service company. It is one of the world's largest oil field service companies. The Baker Hughes rig count is an important business barometer for the oil drilling industry. When drilling rigs are active, they consume products and services produced by the oil service industry. The active rig count acts as a leading indicator of demand for oil products. We've just gone through the main factors that have impact on crude oil prices and determination of crude oil prices, bearish and bullish factors in 2017, drivers actually that could have impact on crude oil prices, and finally, the most important crude oil reports that come out on weekly basis that should be closely monitored and followed by crude oil traders because they can really give very good insights of future movements in crude oil prices. Now, I would like to show you how we can follow these reports. So this is our official website, www.fortrade.com, with an extension of /analysis. You can get to our of Fortrade's site that considers deeper market analysis. Here on the left side, you can find morning analysis, evening analysis, all the way down to economic calendar. So if we click here, the economic calendar, it opens up the calendar that considers main economic indicators in more than several countries in the world. So we know that these reports are released in the United States of America. Here on the left side, we have filters. We can choose filters. And we can choose the country that releases these imports. That's United States of America. Level of importance. Let's choose a middle one and